Hi, and welcome to Hedge Fund Manager. I'm Karl-Mikael Siding. Now let's take a look at P equals F times V for AbbVie. Again, remember what we are trying to estimate here. It's not that hard, but you just have to hammer in the method. So we want to know how the fundamentals will evolve for the company. The fundamentals being what the company is actually doing, what they are creating, manufacturing, distributing, how much revenues that will generate for the company, what it costs for them to do this, meaning what will they get over in net earnings and cash flows, and then finally, how will investors value that fundamental. So the investor is looking at many different investment prospects. They can see what revenue streams a company has generated, how much cash flow that has produced, how the cash flow has been oscillating, fluctuating, or maybe just overall growing over a long period of time. And this influences the investor's idea of how futures cash flows the trajectory of future cash flows, and that in turn decides how many times the current cash flow level the investor is willing to pay. There are a lot of other factors as well. Investors are influenced by stock market trends, by news media, by interest rates, both in terms of their fear of missing out on stuff, their fear of being over leveraged. It can influence how easy it is for the investor to borrow money to buy stocks or buy houses. Interest rates affect how easy it is to borrow on your house to increase your mortgage, and if the interest rate is increasing, then of course you get less money over after paying your mortgage and your interest rates. And again, also of course bank lending standards. So there are a lot of things going on here in our P equals F times V model, which really is the meat of the deep dive. So we have everything here is connected. And in terms of fundamentals, what is a company? Well, it's an entity that designs and produces and distributes products in the widest possible sense, including services, of course. How do they do this? Well, they use their know-how, they have patents, they have tools of varying quality, and they have, not least, wage costs, which usually is the highest cost item for an average company. And they also have input costs in terms of commodities or other input variables. And then what the company needs to do after producing things, using all their technology and know-how, they have to sell this in competition, and this is key, in competition with other companies. And they sell to customers with limited resources. That is also key, because that means that whenever your company wants to sell something to a customer, the customer needs to not buy another product. And customers, they finance, of course, their purchases in somehow. They do it with their wages and by taking up loans. And they too are influenced by marketing efforts, by fads and fashions, by the general sentiment, which also is affected by, for example, the media and stock market cycles, and of course macro trends in variables like unemployment. And as you can see, as I indicated here, is that a company has wages as a cost, but the clients has wages as an income. The more wages paid out, the more the more money customers have to buy things or to buy stocks. Because investors, they finance their stock purchase, of course, with wages, for example, or dividends from the companies they own, or from asset sales, so selling other stocks or maybe gold or houses or whatever, and loans that they can take up with everything as collateral, including their stock portfolio or the house. All of these things are connected, and they also have to the mathematics have to work together. I mean, there can't be any holes in the mathematics here. So all production is sooner or later consumed or discarded. All stock sales are also stock purchases, of course. If somebody's selling something, somebody is also buying that same stock. So you can never talk about net buying or net selling. It's always the same. These things are mathematical units, and all wage costs are wage incomes, and all debts are also assets. If I have lent out money, that is my asset. I am waiting to get that money back. And if I get a credit loss, then I have less assets and less positive sentiment and also less money over for me to invest or buy. All this means that what we are trying to estimate, of course, we are trying to forecast fundamentals, and when we are doing this, we also want to see through the noise of temporary hype based on, for example, rising house prices or falling lending standards, because those things will cycle back. And that means that when we are estimating whether something is cheap or not, whether the current valuation multiple will stay at this level or not, we have to look through these temporary cycles and variables. So what we are also estimating is likely valuations and warranted valuations. So these can differ over time, but in the long run, whatever is warranted will also sooner or later be hit as likely. I mean, we will get there in the end. Unfortunately, it can take a very, very long time. All right, so let's get to the actual forecasts here for AbbVie. As we can see here, the growth rate has kind of stalled out at close to zero. Earnings per share growth is also, well, it's erratic and lumpy and quite a bit negative lately. Let's look at the EPS level. There's something weird going on here. First it increased in a pretty stable manner, and then it has just crashed down to the 2 level. Let's check analyst estimates to just get a clue of what the fuck is going on. And here they are estimating EPS in the level of 10, 12, 15 rather than 2. So something weird is up, but that's because we're looking at earnings per share, not earnings per share, GAAP. And GAAP is generally accepted accounting principles, which is a more strict standard. But over time you can see how it creeps up to almost the actual EPS level. In terms of valuations, EV to sales have increased by quite a bit lately. Price earnings has just crashed upward, and this has also to do with the EPS and GAAP differences. Let's look at another fundamental. Perhaps EV to EBITDA is more stable. Yes, it is. It's between 10 and 15, you could say. And EBITDA is also pretty stable. It's been flat for 4 years. And EBITDA margin is falling slightly. So perhaps EBITDA is the fundamental we should be basing our valuation and forecast on. So I think we should do that when moving over to the final part of this deep dive.